Let me start this episode with a short story, a true short story. A few years ago, a journalist friend wanted to do an article on horse racing. So he ambled into the city's horse racing club and wanted to understand how this took place, the betting on horses, the losses, the wins, and so on. So he was introduced to a sort of a middle-aged gentleman who wanted to know why my friend was there. So when he explained to him, he said, still politely, but a tad more firmly, saying, "This is not a place for people like you. If this is the first visit of yours to a horse racing club, please get out right now." So my friend tried explaining again that he was there to soak in the atmosphere. He was not going to bet on horse races and so on. But the gentleman was still insistent. He said, that is how it starts. People come in to soak the atmosphere, just curiosity. And they are tempted to bet a bit, bet on race horses. Sometimes if you're lucky, you may win a few, and that gets you hooked for life. And then you can't prevent yourself from coming week after week after week, even though you know that your family wealth is going down the drain. Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. Observers are likening trading in futures and options to gambling or betting on horses. Markets regulator SEBI, or the Securities and Exchange Board of India, has come out with a consultation paper that aims to rein in losses for retail investors who dabble in futures and options. In an editorial last week, group publication Businessline referred to derivatives trading, such as in futures and options of stocks, as being addictive, like gambling. On July 30th, SEBI chairperson Madhuri Buch referred to a loss or an annual loss of rupees 60,000 crore that households were incurring. Let me repeat that figure, 60,000 crore, not one time, not by corporates. This was an annual figure that households were incurring. A couple of days later, SEBI board member Ananth Narayan pointed out in a speech that 90% of the time such trades resulted in losses for retail investors. Now, what are futures and options? When did they originate? Today, futures and options are seen as sophisticated instruments used on the stock exchanges or commodities exchanges. But their origins go back a few hundred years. When a farmer was ready to sow seeds for his crop, there was a certain price that was ruling, say for rice or wheat per ton. But he wasn't sure if at the time of harvest he would be able to command the same price. So he entered into a contract with a future buyer, a potential buyer, saying that he will be able to sell it to that buyer at a certain date for a certain fixed price. The price was fixed now. Later, it also evolved to a point where the farmer could say, let me buy the option to be able to sell it to you at a certain price at a certain date. If it did not suit the farmer or the buyer, they did not need to execute these options. Nowadays, derivatives are meant to help in the price discovery for an asset and, as importantly, to minimize the risk of loss. Assuming you own a few stocks and you're coming up against a particular date on which counting was scheduled for the voting for national elections, right? Depending on the results, the stock market may move up or down. So to minimize the risk of your loss on that day, you enter into a derivatives contract, and you enter into a contract in such a way that it minimizes the risk of loss. So if the results mean that the value of your stocks go down, you should have entered into a derivatives contract that helps you offset that loss as much as possible. Now let's look at some recent numbers. For the cash market, the annual turnover has risen about 2 times from FY20 to FY24. And when I say the cash market, it's when you buy stocks, actual purchase of stocks, you pay cash and get say 100 stocks of a particular company, Reliance, Ultratech, whatever. Okay, that's referred to as a cash market. And you can keep it for as long as you want, 10 days, 10 years, whatever. Compare this to the annual turnover of the index options on a premium basis. Between FY20 and FY24, the same period, it rose 12 times from about 11 lakh crore rupees to rupees 138 lakh crore. Now, why this explosion in index option volumes? Mr. Narayan points out that the proliferation of weekly expiries for index option contracts to a stage where every day of the week has an index option expiry. This, he says, has clearly had a role to play. There are contracts where well over 90% of the trading volume in index options occurs on the expiry day, with a significant concentration in the last hour of trading. On expiry day, he says, all other things being equal, the time value in an option premium is naturally at its lowest, and it continues to drop through the course of the day. As such, progressively through the day on expiry day, a speculator can buy option structures with a very small capital, which can possibly provide a large profit even if the index were to move only by a few points. Trading in index options, especially so close to the time of expiry, then starts to resemble a slot machine at a casino, says Mr. Narayan. He says, then you can imagine individuals trying to put in coins into the machine hoping for a jackpot. He is also quick to clarify that not all of equities F&O resembles a casino. He says he is only referring to this particular portion, that is trading in index options very close to the hour of expiry. NSE data shows that more than 92 lakh individuals collectively lost about 51,900 crore during fiscal year ended March 2024 in index derivatives. This even without considering the transaction costs. 99% of these individuals traded in index options, only 7% traded in futures. During a different period, transaction costs stood at an additional 35% of trading losses as per a January 2023 SEBI study. The offsetting gains, Mr. Narayan points out, largely reside with some sophisticated algo-based domestic and foreign high-frequency traders, which means, as the businessline piece points out, there could be flight of capital from the country's retail investors to foreign traders. From an economic viewpoint, Mr. Narayan says this is a huge amount of money that is being frittered away at a large scale. And he also warns that if an unforeseen global market-moving event takes place in that last hour before expiry, amid all this frenzied activity and risk-taking, then the overall impact on the ecosystem, the marketing ecosystem, could be substantial. So, what is SEBI proposing now? It does want to bring in a host of regulations, but the one that might be the most effective at curbing rampant trading is its plan to raise the minimum lot size on contracts from the current 5 to 10 lakh to 15 to 20 lakh and then to 20 to 30 lakh in phases. The government, for its part, also wants to chip in and curb enthusiasm on the part of retail investors. So it has raised the securities transaction tax for derivatives as part of its budget proposals. That's all we have now on this topic, folks, and we'll watch for developments as to how the market reacts to SEBI proposals, and if there's a significant update, we will keep you posted. But before you go away, here's our usual nugget of information in our Did You Know section. Did you know that the first futures trading exchange was the Dojima Rice Exchange, established in 1730 in Japan for the purpose of trading rice futures? And here's the quiz question for the week. When did the Western Hemisphere see futures trading, and in which country did it begin first? Here's the answer to last week's quiz question. The question was, as per the All India Survey on Higher Education that was conducted by the government for the year 2021-22, how many MBBS graduates were there, given that our country has a total population exceeding 1.4 billion? The answer to that is 54,547 MBBS degrees were awarded. And before you switch off and move on, do not forget to like, share and subscribe if you did like this episode. Until we meet again, have a lovely week ahead.